How to pick a debt mutual fund. While most investors in India understand they shouldn't invest in equity mutual funds by solely looking at the past or recent returns of funds, when it comes to investing in debt funds, more often than not, this is the exact thing they do. However, just like in equity, this approach is quite risky in debt too. That's because higher returns, irrespective of type of investments, are mostly generated by taking higher risks. And if any of those risks play out, you might find yourself in a situation you are not comfortable with. In this video, we will tell you how you should go about investing in debt funds. But before that, just a quick reminder. If you are interested in more videos like these, make sure you click the subscribe button and hit the notification bell. Now back to our video. Let us begin by understanding the risks in debt funds. Debt funds have two major risks. They are interest rate risk and credit risk. First, let's understand what is interest rate risk. Debt funds invest in debt instruments or bonds. Just like stocks, bonds are also traded in the market on a daily basis, and their prices also move up and down, driven primarily by how interest rates are changing or how people expect them to change. Whenever the interest rates go down, or people think that the interest rates are likely to go down, the bond prices go up due to high demand. Let's understand this with an example. Suppose a debt fund holds a bond that is paying a 10% annual interest rate. Now, if the interest rates in the economy fall, any new bond coming in the market will give a lower interest rate, say 9%. And because of this, the demand for the old bond giving a higher interest rate increases. This leads to a rise in the price of the bond and subsequently the NAV of the debt fund holding it. Similarly, if the interest rates go up, bond prices come down because now the demand for this bond that is paying a lower interest rate decreases. This price movement of bonds due to interest rates is called interest rate risk. Now let's understand the second risk, that is the credit risk. You may have heard of personal credit scores like the CIBIL score, which reflects how well you have managed to repay your debt obligations, like loans in the past, to give you a score. In a similar manner, there are ratings for companies too. These agencies are called credit rating agencies. Companies like CRISIL and ICRA are two examples of such agencies. These agencies look at a company's financials and its past history to assess its debt repayment capability. And then a rating is assigned to reflect this capability. AAA is the highest rating, which indicates it's almost certain the company will repay its debt and hence has low credit risk. Next is AA, which indicates relatively less certainty, so a slightly higher credit risk, and so on. This goes all the way to D. D is given when a company has not paid its loan back or it looks like it won't be able to pay back. The best way to avoid this risk is to invest in the debt fund that lends to highly rated corporates. Now that you know the risks, let us see how you can approach investing in debt funds. To help you understand this better, we divided the most popular debt fund categories into three distinct types for the purpose of making it easier to understand. Let's name them: Safety First, FD Plus, and Beat the FD. Safety First. Two fund categories, overnight funds and liquid funds, fall in this category. These are the safest funds in the debt category with negligible interest or credit risk. In these funds, safety and liquidity take the highest priority, with returns being an outcome of the first two factors. Although they are considered a good option for keeping cash you might require immediately or for emergency needs, you can also use them for investing for longer durations too. That's because the difference in returns between these and slightly higher risk category funds isn't too much, and therefore you will see a higher difference in absolute amount only if you invest a significant amount. So if you are a conservative investor, pick one of these two fund categories for your entire debt allocation. Ideally, overnight funds are good for up to 7 days of tenure. You can consider liquid funds for investment horizons that are higher than a week. Let's look at the next type, FD Plus. We are calling this FD Plus not because they are an enhanced FD product, but because the returns generated by these fund categories are slightly higher than what FDs of the same investing duration tend to give. Low duration funds, short-term fund, corporate bond funds, and banking and PSU funds are the categories that constitute the FD return type of debt funds. These funds are low on both interest rate risk and credit risk, with high credit quality bonds, AAA or equivalent. Forming the majority of their portfolios, FD plus type of debt funds give slightly higher returns than safety first debt funds, without compromising too much on safety of your investments. If you are looking to invest for 6 months to 1 year, you can consider low duration debt funds. For 1 to 3 year investment periods, all the remaining categories are ideal if you are willing to take slight risk. Among these FD plus type of debt funds, banking and PSU have the least credit risk, followed by corporate bond funds, short-term funds, and lastly, the low duration funds. Now let us tell you about the last type, that is, Beat the FD. Fund categories in the Beat the FD are for investors seeking returns that are meaningfully higher than FDs and are okay taking a higher risk for these higher returns. Dynamic bond funds, credit risk funds, and debt-oriented hybrid funds are categories in this. These funds take different approaches to generate higher than FD plus type of debt funds. Approaches can range from taking interest rate risk or a mix of credit risk and interest rate risk, to adding a small portion of direct equity, that is stocks, in the portfolio. Let's look at those approaches in detail for a better understanding. Timing the interest rate approach. In this approach, the fund manager actively manages interest rate risk to fetch higher returns by timely buy and sell calls of bonds of different tenures. Dynamic bond funds use this strategy. However, for this strategy to be successful, the fund manager needs to time the interest rate cycle right. A wrong call can lead to losses. Credit approach. Here, higher returns are generated primarily by investing in lower rated instruments that offer higher yields. Credit risk funds follow this approach. While these funds have some interest rate risk, credit risk tends to be larger risk than interest. A very poor quality of portfolio or concentration of holdings in low quality bonds means you can see losses if the underlying company's capability to service the loan repayment obligations is affected in a negative manner in times of economic distress or unfavorable business cycles. Hybrid fund approach. In this approach, the fund allocates 10 to 40% of its portfolio to equities to enhance the returns. Equity saving funds and conservative hybrid funds are examples. While conservative hybrid funds allocates between 10 to 25% to equities and remaining is invested in debt, equity saving funds use a mix of equity, arbitrage, and debt in almost equal proportions. Since the portfolio of these funds have equity exposure, the debt portfolio of these funds is typically low risk, with high credit quality papers and bonds with low interest rate risk. All these categories under Beat the Type FD are ideal only if you are looking to invest for at least 3 years with an appetite for volatility in the period you stay invested. To conclude, investment in debt funds should be a core part of one's asset allocation. But before taking the decision on which fund to invest, it's important to zero down on the right category that suits one's risk appetite and investment horizon. It is good to always remember, debt funds should be more about adding stability to your portfolio and less about higher returns. With this as underlying principle, most investors would do well by restricting their investments to safety first and FD plus type of debt funds. And with this, we come to the end of our video. Now that you know how you should pick a debt fund, start investing in them now. Download the ET Money app by clicking on the link below and invest in 0% commission direct plans of top debt mutual funds. It's 100% paperless and completely free. Until next time, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.